Hello, this is Carlos Asilis from Glovista Investments, here to share our market outlook for the week of April the 26th. First, a brief recap on this past week's major macro and market developments. At the macro level, the calendar continues to support the thesis of ongoing acceleration of activity globally. For example, a number of indicators this past week out of the US, such as new home sales, such as market service sentiment indicator. Out of the Eurozone, we got stronger than expected manufacturing confidence indicator, and we also got weaker than expected or lower than expected jobless claims numbers out of the US. Moving on to the virus front, the rate of vaccination continues to improve, and while there are bouts of increased infection rates out of certain areas of the world, including India, Turkey, several states of the US, certain countries out of Latin America and Europe, the reality is that the economic activity calendar remains resilient to these spikes of infection around the world. And this, of course, is evident in a number of indicators, such as the Google mobility metrics that we track. Moving on to the policy front, this week it brought about two important developments. The European Central Bank held an important meeting at which it reaffirmed its dovish stance in terms of its quantitative easing stance. In addition to that, the Biden administration put forth a capital gains taxation proposal, which, while initially it impacted adversely equity indices in the middle of the week, markets proved resilient. Market indices actually had a flattish week. Emerging market equities and U.S. small caps outperformed U.S. large caps and U.S. tech. In the case of U.S. tech stocks, they recorded a decline of about 72 basis points. This is for the Nasdaq Composite, while S&P 500 declined by about 13 basis points and emerging markets strengthened by about 32 basis points for the week. In terms of our investment thesis and how these macro developments translate into our investment thesis, we continue to favor value stocks over the medium term vis-a-vis growth stocks. This thesis is being reaffirmed by a number of important developments. Number one, the taxation proposal out of the Biden administration is bound to impact growth stocks disproportionately. I think this will reinforce the supportive backdrop for value stocks. Secondly, as we approach the middle of the year, the pace of vaccination out of Europe and out of emerging market countries is going to improve significantly, thereby favoring those bourses which are dominated by value sector indices. And third, when we look at the economic activity momentum globally, a lot of indicators such as the ISM indicators have essentially peaked out. And history reminds us that value stocks tend to outperform growth stocks as we see a deceleration of economic momentum, which is our thesis going forward. This coming week is a very busy week. We witnessed the release of close to 35 to 50% corporate earnings out of the US and Europe. This includes, of course, the Facebooks and Apples and Microsofts of the world. In addition, we also have a busy week at the macro level with an FOMC meeting on Wednesday. And we also have a number of consumer and industrial sentiment indicators out of the US, such as the University of Michigan, the Conference Board indicator. We wish you a good week, and thanks again for your time.